Everything you need to know about products and services that can improve your life. This is Experts on Call on CL 650.
And welcome back. This is 650 CIL's Talk About Strata. I'm joined in the studio tonight with Gord Lee, who is the Vice President for CMW Insurance Brokers, and Trudy Lancelin, who is the Deputy Executive Director of the Insurance Brokers Association of British Columbia. We're talking about, obviously, insurance, which would be logical with the two of you in the studio. And we've been talking about the essential basic for stratas that the Strata Corporation has to insure for all common assets, common property, and fixtures to full replacement value. The Act sets out a list of perils, which are going to be the typical things like water escape and flood, and boiler and machinery, and windstorm and hail, and impact by aircraft. And that's an interesting one because we actually have that. We have claims around impact by aircraft in British Columbia every now and then. So it's kind of an interesting relationship. One of the things I think that gets a lot of attention, though, that people don't really understand is co-insurance. And we get a lot of questions about it, Gord. And with respects to the Strata Property Act saying that you have to insure for full replacement value, that's what it would cost to replace and repair today. But how does co-insurance play into that?
Co-insurance would only play into that if the Strata opted not to have an appraisal.
Right.
So, and then there's a claim. And when that claim occurs, the adjuster comes out and an insurance company looks at the building and says, this building looks like it's underinsured. And they usually would then, if they feel that way, they would go and get an appraisal. They would pay for appraisal done and say, hey, this building is uninsured. And then they would penalize that claim by proportional to the same percentage that's underinsured by based on the co-insurance penalty clause that's in the policy.
So let's put that into language that everybody can understand. So I'm in let's say a 10-plex, 10-unit townhouse complex. We should be insured for $2.8 million, but we're actually only insured for $2 million. So we're about 75% of what we should be insured for. So if we had a claim, it's possible that only 75% of our claim would be covered.
Yes. So
it's a simple way of looking at it.
Let's do a simple math. Say a $10 million building.
Right.
It says 90% co. So what it says is that if the true replacement was $10 million and you only insured it for $9 million on a partial loss, you're okay.
Right.
Because they allow for that 10% margin of error.
Okay.
The issue people are gonna run into is that if they insure the building for $8 million, but really should be 10, 90% co-insurance says the real amount's 10. You're allowed to, within a 10% margin error, but you're below the 9 now.
Right.
So you're at 8 million.
Right.
So they would then calculate the percentage difference between the 9 million to the 8 million.
Right.
That ratio difference, that ratio that you're underinsured by would be charged against you on that loss.
So 12.5%. So, so we're looking at a co-insurance clause if you're not appraised and not insured for full replacement value. If you have a claim, now is it the amount of the claim that affects that? So if it's a $50,000 claim, is that going to be affected? Or if it's a $500,000 claim?
Both. The only time that, of course, is that for a partial loss. So if it's a total loss, it's very simple. If you insure for 8, you only can get $8 million. So you're penalized anyways. But people don't realize is that what you will have sometimes clients saying, well, I don't understand, Gord, I got $8 million of coverage. The claim is only for $50,000.
Right.
There should be adequate coverage. But what the insurance company is saying that, well, we don't know what part of $8 million out of the 10 you're insuring. Is it the two units on the right or the 2 units on the left? So instead of looking at these, is that in proportion across the whole building is that percentage that you're underinsured by.
Right.
So any losses, we just penalize you for that same percentage across the board.
So in addition to your deductible, the Strata Corporation may find that they're paying what the percentage difference is between the co-insurance amount and what the appraisal amount is.
Yes.
And so it could be it could be quite extreme if the appraisal is or if they didn't have an appraisal.
Yes.
And it's quite inaccurate, or if there's an issue with the appraisal.
Yes, and I think commonly what we see those issues come up is that actually off new development, the developer gives the Strata Corporation a number, said this is my cost of construction, and where we saw extreme case of this is actually the Olympic days, pre-Olympic days, where the developer said, this building $60 million, that's what it costs to build this high rise.
Right.
And then really the claim comes along and you do the appraisal based on, because, this thing was built 3-4 years ago, and as
Right.
time moves on, this thing is like $80-90 million to build now. And,
Right.
and so, they have a loss, and the Strata Corporation ends up getting hit really hard with a huge penalty.
So in that case, if it goes from 60 to 90 million, we're talking a 30 to 40% variable.
Yes.
And if it's a significant enough claim, that's a huge amount of money for a strata to pay because they didn't get an appraisal and they're not insured to their full appraisal value.
Yes, that's what would happen.
So that's one thing that consumers absolutely need to be
Yes.
aware of when, especially strata corporations, when they're doing this. In essence, they are taking a risk if they don't have an appraisal. And putting themselves in a situation where they could be underinsuring.
Yeah, and I'm surprised that, strata corporations sometimes, if any, choose to do that. And there are ones out there that do that. And I always advise them, I say, it's a little different if you own your own home. You could choose not to insure it, partially insure it, take the higher deductibles, whatever
Right.
you like, because that's your own responsibility. At the end, if you don't have coverage or there's, there's only a partial payment, you would take responsibility of it, and that's your plan. But you're acting on behalf of all the owners when you sit on the council. And so you do have to think that you can't make that type of decision for everybody else to take that type of risk on. So I think that's something that people have to really understand when you sit on a council. You are representing all the unit owners, and you must have to protect them.
I was going to say,
properly.
Trudy, from appraisers and brokers' side point of view, from the appraiser side view, what happens when an appraiser makes an error and there's an undervalued amount? What if they've excluded something?
I think there have been perhaps times when brokers have, just with their own knowledge of the area and of the property and of the community, have perhaps noticed that and have gone back and asked for it to be reviewed. And I think that's something that even the strata council or the property manager, if there's something that just seems to jump out as perhaps an omission or something there, then
Right.
then certainly query it and get that answered. But I think for unit owners, it's certainly a good idea to keep an eye out for things like that, for the fact that there is an annual appraisal. I think some strata councils can really feel a mandate from their fellow owners that they have to operate as tight and lean as they possibly can, and everybody, I mean, nobody likes strata fee increases.
Right.
And if you're looking at even a couple of things on the operational budget going up, it can potentially trigger a 5% or 10% increase in the strata fees, and that's a pretty unpopular thing to go to the owners with at an AGM. But it's a false economy to think that you can skip an appraisal or reduce coverage. I think it would be probably a very prudent thing for owners to consider passing bylaws that make things that aren't covered in the Act as mandatory coverages, like earthquake, make them mandatory so that future strata councils don't feel some pressure to, by keeping the premiums the same, look for ways to reduce coverages, that can end up in some of these situations that Gord and you were just talking about. Again, a false economy if something should really go wrong.
So let's just go back to the fact that strata council members are volunteers. So I'm going to tell you a big secret, Gord. Earlier you said you don't often go to buildings to scrutinize the buildings to see what conditions are, basically, suite by suite, floor by floor. Nobody does it. I think that's inherent in the industry. It's rarely done. But here's the secret. Most strata councils actually never see their appraisals to look at them anyhow. The appraisal is ordered, they pay for it, goes to the property manager, goes to the broker makes the assumption that the appraisal is accurate, and it's posted and the amounts are done. But I've seen appraisals that identify property that isn't even part of that property because it was just an appraisal boilerplate that was taken from another project. There are some inconsistencies in this. So I think message to consumers, you're on strata council, get your hands on a copy of your appraisal.
Yeah.
Look at the appraisal. Look at the insurance policy. Figure out what you're actually insured for and what the appraisal actually means. That's one of the things people have to start doing.
And make sure the appraiser is qualified, has errors and emissions insurance, things like that. I have heard, and I think you have too, Tony, situations in perhaps some of the rural areas and in the interior and whatnot, where There just aren't that many appraisers around, and so it's hard to get, and they're, quite often pricey. To be honest, I don't know what the solution to that is. You probably have dealt with some of those issues, but again, I think that, it's it's in the Strata Property Act for a reason, for consumer protection reasons, and it ensures that the insurance is meeting the legislative requirement for full replacement cost. They're they're good to have.
Well, the act is there on purpose to prevent my neighbors from cheaping out on me and putting me at risk.
Exactly.
That's the whole purpose of the act, right?
That's right.
They can't say, well, look, we're going to just get the cheapest insurance we can. We don't really care about the coverage or any of what the conditions are, and we'll just kind of roll with what happens. And then my investment's at risk because of this. That's, as a homeowner, I can buy homeowner insurance to try and fill in the gaps of my strata policy, but it's not going to fill in all the gaps of the policy.
Right.
That's one of the issues that you have. And I think the other thing that consumers need to understand, if you're underinsured and there is a loss or a claim that results in both a deductible and a penalty, Gord, as you've said, there is no insurance to cover the underinsurance. My homeowner policy might pick it up, but it's one of the exclusions under insurance policies is you can't insure for being underinsured, right? That'd be a perfect world, right? You still have to exercise some responsible judgment here. Yeah, no, it's interesting. So take the obligation around coinsurance, and we take this whole concept about the requirement for full replacement value, assets, common property, and we take that, we put that into bare land stratas. So bare land strata is exactly what the word says. It's a bare piece of land. Your strata lot is a bare piece of land, and the buildings, which would be your home, are not shown on the strata plan. Which means they're your responsibility. So the Act segregates this out. So if it's a bare land strata and your homes are not shown on the strata plan, the strata has no insurable interest in the home. They don't maintain and repair the home unless the bylaws require them to. They don't insure the strata lots. And what's interesting in bare lands is, and this is a complaint and a question we get a lot, the strata's insuring has a policy where they're insuring for the homes on the bare land strata. But there's no provision for that under the Act. They haven't adopted a bylaw where the strata is responsible for it. And on bare land stratas, you might have a variation in value of homes from one home worth $250,000 and one home worth $1.1 million because of different locations of property and size of homes and things. So it's not even fair with respects to collective insurance. So one of the issues we have with bare land stratas, though, is bare land stratas now are starting to realize, because they haven't been doing this, that they have a duty to maintain insurance on their in-ground infrastructure, which is common property. So sewer, water, things like sump pump risers, roadways, clubhouses, gatehouses, public liability, light standards. They have an obligation to insure for all those things, and they're starting to see a significant rise in the insurance cost for them. But it's not necessarily resulting in the benefit for the strata, because the issue that they have is they can't get the same coverage for all of those assets that they can get for a building like a strata lot. So I don't know, Gord, how are you guys dealing with the bare land approach with respects to the infrastructure?
We what we do is realize that a lot of the, like, if you go to a regular commercial policy, there's going to be exclusions for anything basically that's underground. So what we've done is that we've understand that the strata corporation is responsible, that the appraisal is showing some of these things. So we've amended some of the wordings in our policies to provide coverage for those underground works.
But what are they actually covered for?
Well, you know what? Probably not. It's not good. You're not going to get a lot of coverage from, like, fire, for example. It's underground, but as a, it could be a extensive flood where it causes damage to the roadway, and underground works are shifted or moved, and the policy is going to have to respond. Or could be an earthquake, and
right.
After the earthquake, the shifting of the ground and those underground works needs to be repaired or replaced.
So you bring up one of my real pet projects, which most people misunderstand as earthquake. So whether you're in a bare land or townhouse complex would be another good example. We have very large townhouse complexes where people are in a situation where their collective infrastructure is not necessarily included in their appraiser. and their appraisal. So, the in-ground services of water, and they have phone utilities, they have electrical services that are running in-ground. They, all of these services that they have, the Strata Corporation has an obligation to maintain and repair them, but insure them as well. So if we look at earthquake, what does earthquake for those services actually cover? Because we see some disparities in policies. They're not all, I think it's pretty obvious that not all policies are exactly the same.
No, like on your earthquake coverage, it's just going to be subject to your deductible and the coverage. I could give an example even beside earthquake. Like, I just thought of this vehicle impact.
Right.
And someone says to me, vehicle impact, how does a vehicle hit a pipe underground? Well, there was in that particular case, there was a
fire hydrant?
It was a shutoff.
Yes.
And it was only maybe about 12 inches below ground.
Right.
The truck drove over this grass area, which it shouldn't have. It compressed that pipe,
right,
cracked the pipe underneath, huge water just bursting everywhere. We end up probably replacing half the driveway, digging it up, and replacing replacing the pipes and everything.
So
there's a claim there that what could happen, because there's people that says, well, why are we insuring for these things when really I don't see any value.
Right.
There's a claim. I think we paid out probably about $50,000 in repairs.
Are there exemptions, things like natural environmental conditions like sinkholes or things like that? Are there kind of exemptions
that would be exempt, but that's a pretty general exemption, because sinkholes that's not something usually what we consider sudden accidental. It's probably gradual over time that something falls out,
right,
and then finally it sinks. So those would generally, you're not going to have coverage.
Explain that to the person who's just lost their car into the sinkhole.
Now, mind you, if it wasn't a sinkhole and I don't know, something impacted the ground and fell down, and put a little hole in the ground, no problem.
Right. Right. So, but it's interesting because many of the policies you look at this is because people aren't looking at their appraisals, right? They're really not, they may not even be seeing them, right? Strata Council might not be seeing them.
Well, I think something else to maybe bring into this mix here is that if it is part of the strata plan and something that is part of the common property, then it should be included in the depreciation report, and the strata and the owners should be planning for ongoing maintenance. If they're responsible for stuff in the ground, then no insurance is ever going to cover normal wear and tear. You're still responsible for normal maintenance and upkeep and things like that. So those better to know now, and make sure that those things are actually being included in your depreciation report and your long-term planning for upgrades and so forth going forward as well. It's not just the insurance, it's taking responsibility for it in a more holistic way.
Exactly. We'll come back after this break and we'll actually talk about earthquake and depreciation reports a bit, because one of the solutions to not having enough appraisers around the province has been depreciation reports, which have provided more work and have had more people available now in the province. So we'll be back right after this break. I'm Tony Giaventu, your host on QuayPacific's Talk About Strata. If you'd like to email us, you can email me directly at tony@choa.bc.ca. And if you'd like more information on the insurance guide, go to the CHOA website at choa.bc.ca, and we'll be back right after these messages.
There's still more ahead with Experts on Call on CL 650.